If you're doing it right, stock picking takes some time. You got to do your due diligence. You got to really look into a company. And so any shortcut that I can find that makes my job a little bit easier, I'm all about it. Grab a drink, take a seat. Let me show you one of the best shortcuts I found. Cheers. The first step for me is almost always the initial stock screening. How do I narrow down all the stocks in the world to a specific category or an angle that I want to pursue to look for the best investment, like in that small pool? And the best shortcut that I have found is to start with one of the most famous, prolific investors of all time, look at their portfolio and see which one of their companies is the best value for investing today. So the person that I'm targeting is Bill Ackman, and I'm looking at his portfolio right here. He only has 10 companies. So this guy has a relatively concentrated portfolio. So I'm thinking, hey, this shouldn't take me any time at all to figure out which one of these is the best value today. Because I'm a value investor, and I think value investing is really powerful right now because there's a lot of uncertainty in the market. There's a lot of indicators that we might have a crash or a market downturn or a recession, something like that coming up in the near future. So a value company is already going to be priced low compared to what it's actually worth. And so if there is a crash, it doesn't have as far to drop. Whereas a growth company, it's overpriced compared to what its current earnings are. And if the market crashes and there's a recession and suddenly we're not in a very good environment for growth, then a lot of that value is going to disappear like that. My first step is to take Bill Ackman's companies and put it into my own stock screener. I like to use stockanalysis.com. I put them all right here. And then I have a few of my own filters that I like to use the most. So first and foremost, price to free cash flow ratio. How much free cash flow am I getting compared to the price of the company? A lower number means I'm paying less for $1 of free cash flow. So these companies at the top look the best. If there is a dash, it means that stock analysis either doesn't have that data or perhaps it's a negative number. Maybe they lost free cash flow that year. So I need to look into these a little bit more. SEG, I'm seeing they have negative profit margin. So I'm going to go ahead and dismiss that one. But Nike, this is going to be the first company that I decided to look at. And normally this goes pretty smoothly, but for this investor, I actually had a lot of trouble finding a value company. So when I looked at Nike, first thing I do is I pull them up on stockanalysis.com. I like to look at their forecast. And right off the bat, this is a major red flag. 2025, the analysts are saying that they are losing, that they think they're going to lose a lot of money, going way down in revenue. And then the lowest analysts think they're going to be losing revenue for the next 5 years. If that's true, then I don't know that I want to invest in Nike. And so the way that I decided to figure out how true this is as quickly as possible is I went to ChatGPT, and I love using this new feature, deep research. It typically takes 5 minutes to do a deep search on the topic that you ask it. So what I said is I'm trying to find Nike forward revenue guidance for fiscal year 2025. Please provide me with a source for Nike's own revenue guidance. So, and then ChatGPT clarifies, would you like me to find Nike's official forward revenue, or do you want analyst consensus? So I said, please exclude analyst consensus. Obviously, I already have it. So this search actually took 10 minutes and they provided me with 24 sources. Really, really good. I've been really happy with ChatGPT's deep search. So in fiscal year Q4 2024, the earnings update, very recently, Nike provided a forward guidance where they said they expect revenue decline by mid-single digit percentage year over year. This outlook assumes a particularly soft first half of the year with the first half of sales down. So they are expecting approximately 10% revenue decline in Q1. And why? So it even gives me the commentary and the context. Nike's leadership characterized fiscal year 2025 as a transition year, adjusted its outlook downward in light of headwinds that emerged in late 2024. He also had the CFO, Matthew Friend, noted disappointing Q4 results, and they're showing product supply adjustments. Nike is deliberately reducing its supply of certain classic footwear to protect brand health, soft consumer demand, and then macro and market headwinds. There just doesn't seem to be a strong outlook for Nike in the upcoming years. And so I'm going to eliminate Nike from my list, even though it was in the best position as far as price to free cash flow. Back to my screener, the next company is BN right here. However, they have a profit margin of 0.72%. This is a red flag. Recently, I read a book, Warren Buffett's red flags that he looks for, and any company that has a profit margin below 10% is a big red flag for him. So this one is so low, so I'm going to go ahead and skip this one. They also have a super high PE ratio of 171. So it doesn't really look like it's going to be a value company for me. Next up is Howard Hughes. So this company, I saw a little bit of a red flag. So I like to use free cash flow as my primary valuation tool. I want to know, how much free cash flow am I paying for? Because the free cash flow is the amount of cash that a company can return to shareholders in one way or another year over year over year. So I like to project what is their free cash flow. This is the amount of money that I'm going to be getting back. And if it's really good compared to the share price, then I call it a value company. When I look at Howard Hughes' free cash flow, I see wild swings. So in 2018, negative 28 million. 2019, negative 364 million, negative 74 million, negative 285. And then 2022, they had some free cash flow, and then they lost a bunch in 2023. When I'm seeing massive swings in free cash flow, it makes it difficult for me to project what is their free cash flow going to be in the future. So once again, this company strikes out. Back to my stock screener for Bill Ackman. The next company in line for price to free cash flow is QSR. This is Restaurant Brands International. And on the stock screener, it has really good profit margin, 12%, good operating margin, gross margin. Their revenue growth is 3.57 over the next 5 years, which could be better. So when I looked a little bit deeper into QSR, going down to the forecast, this is something that I do not like to see. Once again, this makes it really difficult for me to be confident in my forward projections. So the revenue estimates are all over the place. The highest revenue growth projections are 17.9%, like lots of double-digit growth year over year, whereas the lowest are double-digit reductions in revenue. The way I like to forecast future free cash flow is I take the future revenue projections and then I multiply them by their historic free cash flow margin. So the free cash flow margin is the percentage of revenue that a company is able to generate free cash flow. So this revenue growth is really important to my projections. It's all over the place. It's hard for me to feel confident in my revenue projections. So once again, I'm going to skip this company. Going back to my screener, we're now down to Google, which I've already invested in Google in my YouTube portfolio series. So not looking to invest more money into Google right now. I do think it is a great company to invest in, especially when we're talking about the Magnificent Seven. I think it is probably the best Magnificent Seven company to invest in. But moving on, next one is HLT. Really strong margins, profit margin of 32%, gross margin of 76%. This company looks really strong. Revenue growth over the next 5 years looks great, 9%. However, as I was doing my due diligence on Hilton, it looks like they have lots and lots of debt. So their current total assets, $16.5 billion. Their total liabilities are $20 billion. So that means the shareholders' equity is in the negative. So if they had to liquidate everything, shareholders would have nothing. There's just so much debt. For me to invest in a company like this, they would have to be outstanding on free cash flow, and they're just not. So after passing up on another company, we are towards the bottom, CP, Canadian Pacific. It looks like I am about to completely flop with Bill Ackman's portfolio. It doesn't look like I'm going to be finding anything that is a free cash flow bargain because this one's free cash flow ratio is 40. So it doesn't look like the price of free cash flow is going to be very good for this company. But even though I've struck out on all of these companies, I'm going to keep going with my due diligence and see maybe one of these is going to be good in terms of future free cash flow. So Canadian Pacific, Kansas City Limited, CP, when I look at the forecast, I see straight off the bat, the analysts are projecting the share price to go up, but that's not necessarily what I want to look at. I want to look at the revenue growth. And finally, I'm seeing some consistent revenue growth. The lowest analyst projections is -1, -2, -3. So slight shrinkage on the lowest end. The highest end is double-digit growth. So this is a tight enough range for me to go a little bit further. When I look at their balance sheet to see what kind of debt they have, see, go over to the balance sheet right here. Their total assets, $87.7 billion. Their total liabilities, $38.84 billion. So quite a bit of shareholder equity, $48.8 billion is shareholder equity. And whenever I look at the overview, the market cap is $67 billion. So the price to book value is pretty good. The earnings ratio, the PE ratio is solid. Even though the free cash flow ratio wasn't very good at first glance, let's use my free cash flow spreadsheet, which is automated, to see what is the intrinsic value when I look at the projected growth of this company. So the first step for me is I go to the forecast and I need to copy and paste the revenue projections into my spreadsheet. So just gonna grab these right here, I go over to my spreadsheet, which all I need to do is type in the ticker. It automatically pulls up all the information needed to do an intrinsic value calculation. I just have to paste in the revenue growth projections. So once that is in, I can get a first look at what do the analyst projections look like in terms of revenue for intrinsic value. And so right now I'm seeing a pretty wide range in share price, $34 at the low, $103 at the high. However, there are still a few things that I need to enter. The first one being the discount rate. This is the amount that I am discounting the future cash flows to account for the perceived risk of this investment. So 7.38%, that's the discount from a previous investment. I like to go to alphaspread.com and use the cost of equity. 6.29% is the cost of equity for this company. So that's what I'm going to be putting into my spreadsheet. With that, the analyst projections bump up quite a bit, with the average now being $97 per share. And this is assuming that the average analyst projections for revenue are correct. So when I go back to that company, Canadian Pacific, the average analyst projections are 11.5%, 7.5, 7.6, 7.7. So one thing I like to do to kind of corroborate the analyst projections is I want to see what were the company's own revenue projections. I did the same thing with Nike. Now I want to do that with Canadian Pacific using ChatGPT once again. So I said, this is great. Please do the same thing for stock ticker CP. Just to confirm, they want to make sure I don't want the analyst projections. I say correct. After 10 minutes, 32 sources, Canadian Pacific has officially guided for high single-digit revenue growth as a part of its multi-year plan covering from 2024 to 2028. So the company Canadian Pacific is saying that they believe for the next 5 years, high single-digit revenue. And just to be certain, I want to look at their PowerPoint here, 2025 outlook, mid-single digit RTM growth. And what is the date on this? This came out in March of 2025. So this is recent. This is taking into account all of the latest tariff talk, the trade war going on with Trump. It's taking into account all of that information, and they're still guiding high single-digit growth for the next 5 years. So when I go back to the mid-analyst projections, the average, now that seems pretty reasonable to me. 7%, 7.5%, that is high single-digit growth. So going back to my spreadsheet, that puts their intrinsic value at $97 per share. Another thing I should point out, that is assuming that they have the same free cash flow margin that they have had in the past, which is 20%. So after 5 years of high single-digit growth, I'm assuming the next 5 years is going to be 3%. So if I bump that up a little bit, let's say 5% growth for the 5 years following that, and then a 3% growth rate into perpetuity, that puts the analyst average projection at $107 per share. So this company is looking really strong with that in mind. The next thing I want to look at is, should I adjust their past free cash flow margin? So when I go back to their financials, go to their cash flow statement, I can scroll down and see what has been their trend on free cash flow. For the last 10 years, they have been increasing their free cash flow. They did have a big dip in 2020 and in 2023, but for the most part, their free cash flow margin has been solid. However, it does look like they had a couple outlier years for free cash flow margin in 2021 and 2022, which has brought their average up. So when I go back in time, their average does appear to be under 20%. So with that in mind, I think I will reduce the free cash flow expected margin, say 4%, pushing it down to 16. That puts their average analyst projection at $81 per share, assuming that their free cash flow drops back down to where it was before and they're not actually going to be able to keep it up at that 20% level. They still have a significant upside with the average analyst projection. And with the high analyst projection, $124 per share. With their current share prices at 72, this company has a significant upside. So this is the company that I'm going to be investing in this week. This is my YouTube public portfolio series. And really quick, I want to show y'all the portfolio. We started this in December of 2024. Some holdings are green, some holdings are red. As a whole, we are down $6.83. So we're virtually flat, which I'm really happy with because the S&P 500 is down about 10% since we started in December of 2024. And that's because I'm using a value investing strategy, which is a little bit more defensive and less aggressive. So I'm really happy with how it's going so far. If you want to see last week's investment, check it out right here. I hope to see you there. Cheers. What is your drink of choice? Mine is bourbon. Are you guys more into vodka, gin, tequila? Let me know in the comments. Cheers.